A very good evening, friends. I'm Sanjeev Singhal, Central Council member and Chairman Auditing and Assurance Standard Board of ICI and Chairman Sustainability Reporting Standard Board. I welcome you to our webinar on Rule 11E and 11F of the company's Audit and Auditor Rule relating to utilization of borrowed funds and dividend. Friend, this requirement is applicable from the financial year 21-22, for which currently the audits are being done. And I would also like to share with you that today is the 34th program of the Auditing and Assurance Standard Board for this council year, and more than 26,000 members in aggregate have joined these programs. So thank you for your continued support. This program is a part of our web series on the various auditing standard. And now, since we have completed the auditing standard, we have moved to certain other aspects. And then we'll be moving to Caro. And then we'll be taking up also the webinar on the audit of the individual items in the financial statements as well. So this is a continuous learning series which we are hosting. Friends, I'm also happy to share that the Auditing Standard Board has also taken an initiative of helping our members during the course of their audit by answering their queries. So if any member has any query pertaining to the auditing aspect in the statutory audit of any company or partnership firm or a sole proprietorship or a trust or a society, we have formed an expert panel which is functioning from 16th of April and which will continue up to 30th of September. This is the largest ever mandate which would have taken because there are 14 lakh companies. And even if I assume only 6 lakh partnership firms and proprietorship which have to undergo an audit, so we'll be addressing queries for 2 million entities. And for this, we have a panel of 50 experts. And if need be, we'll expand that panel. But our endeavor will be to answer every possible query relating to the auditing aspects. But of course, the auditor remains responsible for the final audit report that he issues. Friends, today it's indeed a pleasure that we have two very eminent speakers for this webinar, including our Honorable Past President, C.A. Manoj Fadnisji, and another speaker, C.A. Deepa Agarwal, who is also a special invitee with the Accounting Standard Board. I'm aware that our past president, Sir Manoj Fadnis, sir, doesn't need an introduction. However, maybe for the generation which has just joined ICI as a member, I think it will be useful to know that what's been the contribution of Sir. So Manoj Fadnis, sir, has, as I said, has been the past president of ICI. Not only this, he's also been a past president of the Confederation of Asian and Pacific Accountants, CAPA, where 32 professional institutes from 23 countries from Asia and Pacific regions are there. He was elected as a president of ICI in 2015-16. He's also been a non-executive director of IRDA, member of the National Direct Taxes Advisory Committee of CBTT, a member of the Company Law Committee set up by MCA in 2015 for the amendments required to the Companies Act 2013. And on 8th, as we said, he became the president on 8th of CAPA on 8th of November 2017 for a term of 2 years. And he has been a board member since February 2015. He's also served as a chairman of the Public Sector Financial Management Committee of CAPA from November 15 to November 17. He was also nominated as a member of the Small and Medium Practitioners Committee of the IFAC for 2016 to 2018, and has been nominated on B20 for the year 2018. And B20 is a business group formed by G20 and is based in Buenos Aires, Argentina. He's an independent director on the board of Federal Bank and serves as chairman of the audit committee. He's also on the board of other listed and non-listed companies. He was nominated by SBI as a director on the board of State Bank of Indore from 2002 to 2005, and he was on the Pradesh Stock Exchange from 2012 to 2014. Sir has published over 1,000 technical papers and the seminars within India and internationally, and his passion for the profession. Friends, a few years ago, we ran 19 batches of the NDS course, and Sir has taken a 3.5-hour session in each of these batches. So hats off to you, sir. And recently, I was fortunate to visit Indore, wherein I had the first-hand opportunity to listen to you on Rule 11E and F, and I thought that these are very important. So let us have a webinar for the benefit of membership in general. And Deepa has been a significant contributory to this guide that's been published by the Auditing Standard Board. So we have brought both of you on the same platform, sir, and would request you to kindly take it forward. And my sincere thanks to you and Deepa for sparing out your valuable time. Thank you, sir, and over to you, Manoj Fadnis, sir.
Thank you very much, Chairman of the Auditing and Assurance Standard Board, Chairman of the Sustainability Standards Board, CA Sanjeev Singalji, who has been doing enormous work, not just in the auditing and assurance areas, currently as Chairman of this board. Earlier, I have seen him working for the Accounting Standards Board right since 2010 when I was chairing that board, and Sanjeevji was an expert assisting the board in terms of convergence to the Ind AS. So thank you very much, Sanjeevji, for all your work, passion, and devotion to the profession and the enormous work that you have done in the COVID period. Also, last year, I had the opportunity of working in a group chaired by Sanjeevji, which is in the process of bringing out audit tools for the benefit of members. And I'm sure one day that will reach a stage when those audit tools would be available to the membership at large, and which could effectively help all of us as small and medium practitioners to further improve upon our audit quality. I'm very happy to join this webinar also with CA Deepa Agrawal. As I understand, she has been one of the pillars in bringing out this implementation guide, which the AASB has released recently. So friends, what we are discussing today is something which is applicable to all companies, be it private companies, listed companies, companies complying with AS, Ind AS, whatever be the nature of these companies. The company's accounts and auditors rules, and particularly what we are discussing is Rule 11E and Rule 11F, which is being made applicable for this financial year 2021-22. So as we audit this financial year, this is for the first time that the auditors will be required to report upon these two new sub-rules which have been inserted. Important for us to bear in mind that Rule 11D, which was with respect to demonetization, the disclosures which were required for the limited period from November 2016 to 31st December 2016, that sub-rule having been deleted, now it is no longer required for any auditors to comment upon that, because that rule was specifically for a particular event, that was the demonetization which took place in 2016. So friends, I would start this presentation with take you through the broad requirements of Rule 11E and Rule 11F in next around 40 to 45 minutes. And then my colleague CA Deepa Agrawal would take us through in detail the various audit procedures and other examples, which in a way she herself has worked upon in this implementation guide. So I hope my screen is visible, and I'll be making this presentation. Wherever I'm not audible, I would request our technical support team from AASB to just let me know. So friends, this company's audit and auditors rules, as I said earlier, were amended last year by the notification issued by the MCA, requiring the auditors to report on these two additional aspects, Rule 11E and Rule 11F. So what is really required in this is with respect to what has been going on in many corporates where funds are invested by one company into another company. The second company invests them in a third company in the fourth company, and somewhere in the channel, the funds land up in some cases in the private companies of the promoters. Now, this clandestine sort of usage of public funds for the private enterprises of the promoters is not only illegal, but it is also possibility of money laundering is very high in such transactions. And therefore, to curb such practices, the Ministry of Corporate Affairs has brought in this reporting requirement, which is envisaged in Rule 11E. Rule 11F deals with payments and declarations of dividend. While as a part of our audit, we are required to ensure that the dividend is declared and paid in accordance with the provisions of the law. But so far, we were not required to report on this matter. But under Rule 11F, this reporting requirement is now brought in, and the auditors will be called in to report whether the dividend declared and dividend paid is in accordance with the provisions of Section 123 of the Companies Act 2013. Now, Rule 11E is containing 3 parts. So what is envisaged is that there is a company A, which is called the funding company. It gives money to company B. So let us call the second company as an intermediary, and there is an ultimate beneficiary. So we are looking at a scenario where there are, say, 3 or more parties involved. One is the funding party, second is an intermediary. The funding party gives the money to the intermediary with very clear understanding, which may be in writing, which may not be in writing, and which could be directly or which could be indirectly, whereby the second party, second company gives that money or uses that money for giving bank guarantees or corporate guarantees in favor of an ultimate beneficiary. So the reporting which is envisaged is under Rule 11E Roman 1 in context of the first party, which is the funding party, under Rule 11E2 in respect of the intermediary. So let us look at what is asked for the auditors to verify. So 11E asks, and that is where the auditor is required to report whether the management has represented that to the best of its knowledge and belief, other than as disclosed in the notes to the accounts, no funds have been advanced, loaned, or invested by the company to or oblique in an entity or a person with an understanding that the funds will be further lent or invested in others or entities or be provided as a guarantee or security on behalf of the ultimate beneficiary. So Rule 11E1 is requiring the auditor to state whether he has obtained a management representation. So ultimately, the responsibility is first on the management. And as we will see further, even the Schedule 3 has been amended. And Schedule 3 amendment requires the board of directors in the financial statements to categorically give this information, whether it is a funding party or it is an investing party. And basis that information which is given in the Schedule 3 notes, the auditor is reporting as to whether the management is represented. So it is in a way first very clearly putting the requirement of reporting through the notes to the accounts in Schedule 3, and then the auditor giving an assertion whether he has also obtained a management representation to this effect from the as just mentioned. So Rule 11E1 is with respect to the first party, which is the funding party. Rule 11E2 deals with the intermediary. Now the intermediary in this case, in the case which is envisaged, is which receives funds from a funding party and uses them for the benefit of certain identified ultimate beneficiaries. And therefore in Rule 11E2, the management representation is with respect to no funds have been received by the company from any person or entity which is further advanced or invested in other persons or entities or provides any guarantees, security on behalf of the ultimate beneficiary. So 11E2 is in the context of the intermediary, and Rule Rule 11E1 is in the context of a funding party. Now, an intermediary would be receiving funds and would also be lending funds. And it is also possible that an intermediary could be, in case of when it receives, it could be giving it to another company, and that third entity would then be giving it to the ultimate beneficiaries. So depending on the facts and circumstances of the case, both 11E1 and E2 could be applicable in context of a particular company. So that is what we need to be careful about. And the third aspect which is envisaged in 11E is where the audit procedures come into discussion. It says that based on such audit procedures that the auditor has considered reasonable and appropriate in the circumstances, nothing has come to its notice that has caused an auditor to believe that the representation under point 1 and point 2 contains any material misstatement. So, as is a very standard auditing practice that we take a management representation, but having taken a management representation, the auditor is supposed to verify that management representation. He cannot just say that I have received this management representation and I will not carry out any further audit procedures. So that is not what is being taught to us under the standards on auditing. Therefore, in Rule 11E in the third bullet point, the auditor is now required to state that based on such procedures as considered reasonable and appropriate in the circumstances, nothing has come to the notice that causes an auditor to believe that the representation under point 1 and point 2 contains any material misstatement. Now, in most of the cases, there may not be a need to report on this because there may not be any such kinds of transactions. Even if there is no transaction, in Schedule 3 notes, the company is required to give a disclosure that there are no such transactions. And therefore, when the auditor is reporting, the auditor states that to the best of its knowledge and belief, other than as disclosed in the notes. So that disclosure in the notes is mandatory in all the cases. Even if there is no such transaction, the fact that there is no such transaction will also be required to be reported upon. So that is what is envisaged in Rule 11E, and Rule 11F is in context of companies which are declaring and paying dividend. Whether the dividend declared or paid by the company is in compliance with the provisions of Companies Act 2013. So we have Section 123 of the Companies Act, which requires that proper depreciation is charged and the profits are computed in accordance with the provisions of the applicable accounting standards prepared in accordance with Schedule 3, and that on that basis the profits are declared and paid. So the requirement under Section 123 and the applicable rules is what is required to be looked into while commenting on 11F. As I mentioned earlier, even prior to the insertion of Rule 11F, the auditor always had the responsibility to verify with respect to declaration and payment of dividends. But it is now for the financial year 21-22 that this reporting requirement is being specifically brought in under Rule 11F. So this is what is covered as far as the auditors are concerned, and Schedule 3 to the Companies Act gives this additional reporting requirement for a company, if whether it is a funding party or it is intermediary. The company will have to give this additional disclosures. So what is required is that if the company has lent such money with or without being reduced to writing, directly or indirectly, so all kinds of circumstances are covered. The onus is first on the directors to make this statement. And if they have lent, if the company has in case lent the money, then it is required to give the date and amount of money which is invested with respect to company which is covered in 11E1. And if the company is covered under 11E2, it is required to give the details of each intermediary or the funding party from which it has received the money. So the date and amount and the party from which it is received and the party to whom it has given is required to be disclosed. Then date and amount of fund further advanced or loaned or invested to the ultimate beneficiary, that is required to be disclosed. The amount of guarantees, securities which are given is required to be disclosed. And in case of companies where the transactions involve giving loans or receiving money from companies outside India, then whether the provisions of Foreign Exchange Management Act and the regulations prescribed by the RBI under the powers under FEMA have been complied with or not. So this is the requirement for disclosure for every company under Schedule 3, and basis this, the auditor is required to report under Rule 11E. Now, this implementation guide has brought out very clearly that what is being required to be reported by the auditors under 11E covers also what is given under Schedule 3. So once a declaration or any assertion is made by the directors by way of notes to the financial statements, since the notes are part of the financial statements which are being audited, and they are integrated with the financial statements as such includes the notes to the accounts. Therefore, whatever is given in the notes is also a subject matter of audit for the auditors. And therefore, when what we say about reporting under Rule 11E, that would cover even what is given by way of notes to the financial statements in the form of Schedule 3 requirements in this matter. So when the company says it has complied with the relevant provisions of FEMA, the auditor would be required to ensure that what are the applicable provisions under FEMA and whether those provisions have been properly complied with or not, and then accordingly structure out and report in terms of Rule 11E. So 11E reporting requirement is required to be seen in line with what is the disclosure requirement which is applicable to the company by way of this additional information to be given in Schedule 3, again for the first time from the current financial year 21-22. Now this implementation guide, which has been brought out by AASB, has given some very interesting illustrations and very interesting scenarios to understand what is the requirement and how to interpret and how to report in these cases. So the illustrations which are given are very simple but very practical illustrations have been put in by AASB in this implementation guide. So what is brought out is that in Rule 11E1, in the first case, there is a necessity of movement of funds. So when the money is loaned or advanced by the funding party to the intermediary, at that point of time, the reporting requirement under 11E1 gets triggered. Now, assuming a case that the funding party has not given money, but it has given only guarantees, and basis that guarantee, the intermediary has in turn given a guarantee to an ultimate beneficiary. Now, what is, as per the strict wordings of what is required to be reported in the 11E, when a guarantee is given by the funding party and there is no movement of funds from the funding party to the intermediary, the reporting would not be required to be done. And this has been very clearly given in this example, where X is the funding party. It gives a guarantee, it does not give money, it gives guarantee to company B, and basis the guarantee which it has received from X, B gives a counter guarantee on behalf of X for a loan availed by this ultimate beneficiary C from a bank. So the corporate guarantee given by company B is on the strength of a guarantee given by X. But X, which is the funding party, has not given any funds. It has not given any loans. It has not given any investments. And therefore, this is a case which is not covered under Rule 11E1. So this is what is brought out in our implementation guide. Then if there is a movement of funds, if money has come from the funding party to the intermediary, and intermediary in turn has given the money to the benefit of an ultimate beneficiary, then obviously reporting under 11E1 is applicable in case of company A, and 11E2 is applicable in the case of company B. Now, there could be multiple scenarios, and those different scenarios are discussed in this implementation guide. So A gives B and B gives onward lending to C. So this is a scenario which is covered and we have discussed this. This is more as we discussed in the first case. Now there could be cases where money is received from a foreign company, and that foreign money is received from a parent company for the acquisition of another company. So in the illustration which is at serial number 3, there is a company which is based in UK. It gives money to its subsidiary in India, which is company A. And this money is meant for acquisition of another company Y. Now, in this kind of a transaction, we will find that A is an intermediary, which is a company registered in India, incorporated in India. It receives money from another company, that is X, for the purposes of investments in company Y for and on behalf of the parent, which is company X. And therefore, even such type of transactions will get covered under reporting in context of A, which is in this case an intermediary, and therefore the reporting in terms of rule 11E2 would be applicable in context of company A. Then friends, the timing of cash flows is also important. It could happen that the money comes in year 1 from funding party to the intermediary, but the investments are made by the intermediary in the ultimate beneficiary companies in a subsequent year. So there is a time gap, and therefore even such cases will have to be carefully seen, whether it is money received in an earlier year and invested in this year, or money received this year and invested in a subsequent year. So as an auditor, it would be important to look into the transactions, not only of the current year, but also in the preceding years. And when the management representations are taken in this regard, very carefully it should be seen that whether any money was invested or money was received in an earlier year, for which an investment is made in the current year, or money received in this year, no investment made in this year, but investment is made in a subsequent year. So the timings of the cash flow will have to be seen carefully to understand what would be the reporting requirements as envisaged. Then the rule talks about any source of funds. So source of funds could be retained earnings, could be debt capital, could be equity capital. In whatever manner company A gives to company B for the ultimate investment in company C, the reporting requirement will be required to be seen. So the funding party may borrow money for giving it to the intermediary. The funding party may have its own funds, its own sources of money, which it can invest in the intermediary, and basis that the reporting would be envisaged and the reporting would be required. Friends, if we look at the requirements of the reporting requirements, it is lent from directly or indirectly, or it is lent from any sources. So the canvas of reporting is wide, and therefore the audit procedures will have to be suitably expanded to see that the representations are properly taken, and of course proper audit procedures are carried out to test those representations to ensure that there is no material misstatement contained therein. Now, this illustration talks about situation about direct or indirect lending. So in this case, F is the funding party. It gives money to A gives to B, and B gives the money to the ultimate beneficiary C. Now, In case of F, which is the reporting party, the reporting would be under Rule 11E1. In case of A, the reporting would be both under Rule 11E1 and Rule 11E2, because it is receiving the money and it is also lending the money to company B. And company B is the company which is giving the money received from A and which A received from the funding party to the ultimate beneficiary for and on behalf of the lending companies. And therefore, in case of company B, the reporting would be under Rule 11E2. Now, friends, in the banking circles, as we see today, various kinds of terms are being used. Various new kinds of documents are in place. So the legal terms and legal status of such documents need to be carefully seen. So earlier we had letter of guarantees, letter of credits, and these are terms which are defined in the law and are well understood. Today there are other types of documents which are also being used in the commercial world. So even a letter of comfort is a document which may not have a legal sanctity, but it is a term being used and it is a type of a document which is used for the purposes of lending. So if company A is such a good company, is having a very high credit rating, even a letter of comfort given by company A could be a basis for a bank to lend on the basis of that letter of comfort to the company which has received that letter of comfort. Now, in a letter of comfort, company A which has issued this letter of comfort is not undertaking any kind of legal responsibilities on its shoulders. But the credit rating of company A is so strong that once it has given a letter of comfort, the banks and the lenders would rely on that letter of comfort because of the reputational risk which company A faces. Now, whether this is a legal document, whether it creates charge or securities is not very important. In terms of this reporting, what is required to be seen is, even if there is a letter of comfort which is issued for an ultimate beneficiary on the strength of money which is received by this intermediary, then the reporting would be applicable. So the reporting does not really restrict itself to the known legal documents which are used or legal types of securities which are issued, like promissory note or any kind of a negotiable instrument or a letter of credit or a bank guarantee or corporate guarantees, but it also includes all such new types of documents which are being used in the commercial world. So the purpose of bringing in this, both in the Schedule 3 and the reporting requirement by the auditors, is to see that which are the cases where money is being given by funding party, the original party, to an intermediary, and basis that investment, certain ultimate beneficiaries are being identified and they are benefiting from this process. And if that be so, the law requires such transactions to be first reported, to be disclosed by the company in the Schedule 3 by way of notes, and the auditors to report on them under Rule 11E of these company accounts and auditors rules. So the reporting requirement which is there is, this is an implementation guide. As all our friends would be well aware, we have statements and standards issued by the institute which are mandatory. Second, we have guidance notes which are issued under the authority of the council and which are said to be recommendatory in nature, which is at the second level of hierarchy. And the third level of hierarchy is the implementation guides issued by the Accounting Standards Board or the Auditing and Assurance Standards Board, or by other boards of the institute or of the council of the institute. Now, insofar as a guidance note is concerned, which is said to be recommendatory, we must always bear in mind that if it is recommendatory, does not mean a guidance note is optional. Recommendatory nature of guidance note only means that it is what is recommended by the council to be followed. And in case the facts and circumstances are different, or if an auditor has a genuinely a different view on that subject, he could take a different view, take an alternate route. But the auditor is required to document as to why he has opted not for what is given in the guidance note, but has taken a different stand. So that is a limited difference between what is issued by the council as mandatory and what is issued by the council as recommendatory. The third level is this implementation guide, which is not mandatory, which is not even technically recommendatory. But as far as a member practice is concerned, one should take anything coming from the council as the Bible and follow it in letter and spirit, because that is where the best of the views of the council are captured from all the concerned technical departments, and the council has, through the Auditing and Assurance Standard Board, has issued this implementation guide. And the implementation guide also brings out that the guidance note on Schedule 3, how it correlates what is given in the implementation guide with respect to what is given in the guidance note, which is issued by the Council of the Institute and which is recommendatory in nature. Even the guidance notes requires that the disclosures are required, which are given in the Schedule 3, are required to be reported upon, are required to be audited by the auditors and then reported upon. And the stand taken in the implementation guide is basis what is given in the guidance note. So that is so far as the technical aspect of this implementation guide is concerned. But as I mentioned, it is in the interest of the members to ensure that what is given in the implementation guide is followed in letter and spirit, except in those exceptional cases where an auditor may, for reasons to be recorded in writing, may have a different view on the basis of the facts and circumstances of the case. A very useful illustrative format for confirmation letter is given in this implementation guide, and which could be helpful in terms of taking such confirmations from the management. Then let me touch upon Rule 11F. As I said, Rule 11F is with respect to compliance with the provisions of dividend. Dividend is after the amendment in our accounting standard AS4, and which also corresponds with the provisions of Ind AS 10. Dividend proposed by the Board of Directors is not a liability which is required to be incorporated in the financial statements. Prior to this, prior to the amendment in AS4, the AS4 required that where a statute requires a dividend declared to be considered as a liability, it requires to be provided for as a liability. And AS4 had that position because of the erstwhile Schedule 6 to the Companies Act, which required a provision to be made for dividend declared by the Board of Directors. And that was the position till 2011 when we had Schedule 6 to the Companies Act, wherein it was necessary that once a dividend is proposed, a provision is made in the books of accounts. Schedule 6 to the Companies Act was revised in 2011, and after the introduction of Companies Act 2013, Schedule 3 is more or less similar to what was there in the revised Schedule 6 of 2011. But our accounting standard 4 had a position that had a requirement wherein, because of the earlier provision, the AS4 contained a provision that dividend proposed was required to be considered as a liability. And this amendment in AS4 took place in 2018, and thereafter the accounting standard and the requirements are in sync with each other, and therefore dividend proposed is not a liability which is required to be provided for in the financial statements. This is because the Board of Directors propose the dividend, and the ultimate right to accept that dividend is with the shareholders. It is on the date of the annual general meeting that the liability is set to crystallize once the shareholders have approved the dividend. The liability crystallizes, and on that date, the provision for dividend is required to be made in the books of accounts. As and when the dividend is paid, as in case of listed companies, it is a period of only 5 days within which the money is required to be transferred to a separate banking account, that provision gets discharged. So that is so far as the accounting requirement is there. But the other requirements, the requirements as contained in section 123 is important to see that those provisions are complied with. Companies' payment of dividend and transfer to general reserves rules are also required to be seen. Earlier, it was mandatory for a company to transfer a minimum amount to the reserves, whereas there is no such mandatory requirement under the current rules, and therefore a company can transfer more or less amount from its retained earnings to the general reserves. So the requirements under section 123 needs to be complied with. Companies would be declaring dividend, say in 21-22, which is paid after the annual general meeting of 2022 is conducted. So the auditor would be required to see that the dividend declared is in accordance with the provisions of section 123. During the financial year 21-22, the company would have paid the dividend which was declared by the board of directors or which had been proposed by the board of directors for the year ending 31st March 2021. So in a way, there are two aspects or 2 years which get covered. In terms of dividend paid, it is with respect to the earlier year, 2021, and dividend declared or dividend proposed is with respect to the year ending 31st March 22. And all these aspects need to be looked into by the auditors while reporting under Rule 11F. There could be situations where there could be some legal issues, and those legal issues may not have very definitive answers. Now, as an auditor, it is not for us to enter into the legal debate, but to apply our audit techniques and see that if there is a legal issue, whether that legal issue has been properly addressed by the company, and whether the auditor agrees to that or not, and according to the facts and circumstances, make suitable disclosures in the audit report. So 11F is with respect to compliance for the purposes of declaration and payment of dividend, and Rule 11E is more with respect to loans which have been given with an objective of benefiting certain well-defined ultimate beneficiaries, which may or may not be recorded in writing. Now, if it is recorded in writing, the task of auditors is more simpler. If the recording is not in writing, if it is given not directly but indirectly, and since that is the reporting requirement to be carried out, the auditor will have to carry out more specific procedures to ascertain the correctness of the assertions being given by the management. So it is not only looking at the minutes of the meetings of the board of directors and the other relevant committees of the company, but also being what is said to be professional skeptics, to have professional skepticism in this regard. This does not mean that an auditor becomes an investigator in context of finding out if there is a material misstatement or not. The auditor is entitled to retain the normal audit procedures as per the standards on auditing and look into the various aspects to see whether the statements given by the management are as per the available documents and reports, and then to comment upon that suitably under Rule 11E. So friends, I will stop at this point of time. As I said, we are joined with another very esteemed member of our profession who has been working on this implementation guide, and she would take us through the other aspects covered under Rule 11E and Rule 11F. So thank you very much for your patient hearing. And I pass on at this point of time to CA Deepak.
Thank you so much, sir. Thank you. And it's a pleasure listening to you. And I mean, I understand and I heard of Sanjeev talking about your technical contribution. I think you explained the rule and the new reporting requirement on the auditor in a very simpler manner. So much easier for me to talk about the audit procedure and the reporting. So with this, I'll share my screen and I'll take up the remaining session. Yeah. Hope my screen is visible.
Yes, sir, visible, ma'am.
Thank you. So, so as explained by Manoj sir on the intent of the regulation, why this amendment was introduced. So I just want to start with the fact that we have a very detailed auditor's report. If we talk about as compared to the international reports and these standards. So if one wants to refer to the international standard, which is ISA 700, and if one compares the audit report, which is now what we have to report for the year ending March 22 onwards. So besides your main auditor's report, which is SA 700, then your ICFR report, and then your CARO report. Obviously, this subject is not CARO, but I'm just referring in the context of the length of the report that it is clauses and subclauses put together. It's 50, around 50 clauses and subclauses put together. And if I talk about this particular reporting requirement, and therefore AASB has kept a separate session just for the guide, because the way the requirements have been introduced by the regulator, it is definitely much onerous and increases the responsibility of the auditor. So if I talk about the existing requirements under section 143(3) of the Companies Act, there is already a reporting requirement of talking about obtaining information explanation. So what you can see on the slide between A to J, it is already an existing requirement, and you were already reporting as an auditor for all the companies till the year ending March 2021. So what has been actually changed, and as has been explained by Manoj sir, that what you have to see is addition to this rule 11. So A, B, C is as is, there is no change, and you will continue reporting in your report on other legal and regulatory requirements. And in D, he has already explained the rule 11E and F, and I'll take you through the audit procedures and the reporting requirement. And then there is a on the dividend norms, there is a further addition. And audit trail has been deferred, so I'm not going to talk about anything on the audit trail in this session, but just for the benefit of the of my colleagues, my friends, in looking at the length of the auditor's report and looking at the responsibilities, which have been tremendously increased. Each and every assertion, I think someone raised a question on the audit procedures, and we will talk about the audit procedures. It is very maintain the underlying document as well. Whenever we any inspection, even if we have to undergo a peer review or the QRBs or any reviews by any regulator, we'll have to demonstrate that how we perform the audit only through our documentation. So, so there's a rule. I'll just skip this slide and some of the guiding principles. So I've got the opportunity to support the AASB in working on this guide. So. Some of the just the key pointers which I want to reiterate before I get into the audit procedures. These are applicable from April 1, 2021 onwards, which means these are applicable for the financial year ending March 2022. There were a lot of questions on the applicability of Schedule 3 and the auditor's report. It is very clear, and I think the Corporate Laws Committee also got a clarification that the new rules are applicable for the audits commencing on or after April 2021. So I think if some of you have a question whether it will be applicable for you December 21 while we are sitting in May 2022, but if this question has been asked by anyone, so you can safely say that this is applicable for the financial year commencing on or after April 2021. The report, as I mentioned, the additional reporting will be part of Rule 11, and therefore it will appear in your section Other Legal and Regulatory Requirements. ultimate beneficiary, as explained by my fellow colleague, and the fact that the understanding can be explicit or can be a verbal understanding. So in all the cases, it is not necessary that it will be in writing, and therefore the professional judgment of the auditor becomes takes more importance and is more important, and therefore it's much onerous, as I mentioned in the beginning. Therefore it is a very onerous responsibility to determine how do you actually check the completeness or the intent, how you actually determine the intent or the intent of the funding. So that is something very important, and therefore there is practical challenges involved. Dividend, it covers both interim and final dividend, and I'll touch upon the provisions of the dividend as well. And the implementation guide also provides some guidance on the disclosures with reference to the guidance note on Schedule 3 and the auditor's reporting requirements. Now with this, I'll cover first the management responsibility, and then I'll talk about the audit procedures. So as Manoj mentioned, that it is first of all the responsibility of the management, and there was a slide also which talks about the disclosure in Schedule 3. So when the amendment was made in Rule 11E and F, and MCA issued the company's audit and auditors reporting amendment rules, there was a corresponding amendment in Schedule 3 to the Companies Act. And and what is the amendment? The amendment is management is required to make a specific disclosure in the financial statement as provided under Schedule 3 to the Companies Act. Therefore, the responsibility is of the management to carefully evaluate transactions of lending or investing in any other entity or to person to determine the nature and purpose of such funding. And it needs to be clearly evidenced and documented while approving such funding. So first of all, it is a responsibility of the management. So as an auditor, you need to inquire from the management about such transactions. About such disclosures, what are the disclosures they're going to make in the financial statements. Also, it is the responsibility of the management to implement internal controls to ensure that risk relating to assertions of existence, rights and obligation, completeness, valuation and allocation, and assertions relating to the presentation and disclosures are appropriately addressed. Then comes the responsibility of identifying and describing the sources of fund for such lending, investing to determine if they would be considered as a funding party or the intermediary. So the management will have to carefully evaluate if the ultimate party receiving the funds is on behalf of the funding party, and the procedures for such evaluation and conclusion has to be evidenced by the management. What is also very important to note is that the auditor should ask for the written agreement, the underlying written agreement. So for example, the various illustrations we have seen in the earlier presentation, if there is a transaction, so for example, if company A is providing borrowings to company B, and ultimately we are saying that company B is passing on the funds to another ultimate beneficiary, which could be company C, then we'll also have to ask for the written agreement. If there is any written agreement between the two companies, or if there's any equity infusion, so the fund, how the funds are being transferred, for what purpose the funds are being given, how it is going to be utilized, so that could be documented in an agreement. Therefore, it is first of all the management responsibility to provide such agreement, and if there is such agreement, there will be terms and conditions of such funding and the purpose for which such funding has been made. So those agreement has to be shared by the management, and as an auditor we need to go through look into those agreement. Also, it is very important, and the guide provides a very I heard Manoj sir saying that auditor is not an investigator. So that is exactly what has been written in the guide also, that auditor is not an investigator or is not required to undertake any investigation here. The auditor will make inquiries from the management. The auditor will look at the loan schedule, which I'll talk about the procedures in the next slide. But the auditor will also, look into the minutes of the meeting. meeting. So in this case, the board has a responsibility to take in record that there does not exist any other oral agreement with regard to lending or investing other than what has been disclosed in the notes to account. The management can obtain end-use certificates from the party receiving such funds to determine the end use of the funds and whether the funds have been onward lent to or invested or used to provide guarantee or security. The guidance note, as I mentioned, is based on it refers to Schedule 3 for the disclosure, and it presupposes a disclosure in the financial statement. So even where management has concluded that no transaction requires reporting. Now, this point is very important. So in many cases, what will happen practically, and you will notice when you will conduct your audits, that management may come back and tell you that there is no such transaction. And therefore, as an auditor, what is your responsibility? Therefore, as an auditor, the responsibility is that we will have to still conduct those procedures, which I'll just cover in the next slide. We'll still have to obtain a management representation. And the management is also required to make a disclosure in the financial statements, talking about there is illustrative wording given in the guide, wherein they have to make a positive affirmation that there is no such transaction other than as disclosed in the notes to accounts, which means the management will have to make an assertion that there is no such transaction, and therefore the disclosures are not being given. So in nutshell, the management will make such a statement, and the auditor will make a reporting in the report on other legal and regulatory requirements, quoting what has been disclosed by the management. Now, before I move to the audit procedures, it is very, very important to understand the what is not in writing. So if you remember the rule talks about whether the funds have been given directly or indirectly for the benefit of the ultimate beneficiary, and such understanding can be in writing or can be verbal. So which means it can be in writing or it could be otherwise. And the challenge comes when there is no written understanding available. So what the guide explains that one needs to understand the timing of the cash flows from the funding party and the lending or investment by the intermediary. So even if the timing is different, presume. So the guide mentions that even if the timing is different. So for example, the illustration which you have seen, the funding was done in year 1, whereas the onward lending has been done in year 2. So the guide mentions that we will have to see the facts and circumstances. And in such cases, it will be presumed that the onward lending investment made by the intermediary is initially out of the funds provided by the funding party. So for example, A has given a loan to B in year 1 of 100, and B has given a loan to C in year 2, and B has a cash balance of 120, and the loan given by B to C is 100. Then it could be very much concluded, depending on the facts, that what is the intention, why the funds have been given, that the amounts have been given by the funds provided by A. So B has given funds provided by A. So auditor has to carefully evaluate facts and circumstances and disclosures under Schedule 3. As I mentioned earlier, auditors are not expected to act like investigator, and thus non-existence of any written agreement or understanding is likely to call for professional judgment, professional skepticism that needs to be exercised by the auditor. And in case there is no written agreement, the auditor needs to take a specific representation from the management listing out each of the identified case in the representation. The auditor is also required to obtain minutes of the meeting wherein the board has taken on record the fact that there does not exist any other oral agreement with regard to lending or investing arrangement. While I move to the next slide, I'll request if anyone has any question, please keep on writing in the chat box. We will take all the question and answers at the end of the session. Now this slide talks about the nature of funds. So we are talking about funding, we are talking about the loans, borrowings. It is very important to note that the funds also include the capital, which means if there is any equity infusion from one company to another company. So that will also be covered within the purview of this rule, which one needs to evaluate. However, funds received as sale proceeds from another entity may not be covered unless and until the sales or sales proceeds have been made with the specific understanding that the company shall lend or invest in other persons or entities identified identified by or on behalf of the funding party. So for example, A is the holding company of B, and A has reached its limits for investment under Section 186 of the 2013 Act. Now, A intends to have one more subsidiary C, but has no direct limits to fund such subsidiary under Section 186 of the 2013 Act. Because Section 186 talk about limits the number of layers of subsidiaries which a company can have. Now, in order to incorporate C and fund C, A enters into an arrangement with B to purchase some of the assets of B, and B shall use the consideration received from sale to incorporate and fund C. So therefore, there is a clear understanding that A has entered into an arrangement with B to purchase some of the assets of the B. So the reporting implication on A is the funding party in this case and will be covered by Rule 11E1. And as mentioned by Manoj sir, one needs to be very careful. A company can be a funding party as well as an intermediary party. Therefore, in this example, probably it may not be true because we have a separate funding party and a separate intermediary. But it could happen that you could have more than one party involved. So if A passes on funds to B and B to C and C to D, then we'll have to see there could be more than one funding party and more than one intermediary. So again, we'll have to go by the intent of the arrangement. Another example is on what I just want to cover here is that it is very important to note that the way the rule is drafted, it talks about the funds. The movement of the funds should happen. There should be funds passing on from one entity to another entity. However, the non-fund is not covered. So for example, in this case, X is giving a guarantee to B. X is not giving any funds, any loan, borrowing, equity infusion, there is nothing. But X is only giving a guarantee to B. So X will not be considered as a funding party since in the whole arrangement, no funds are being transferred. However, if B in turn gives a counter guarantee to C on behalf of X as security, then B will also not be considered an intermediary since it did not receive any funds from X. However, if we just change this example and for example, X gives funds to B and B, instead of giving funds, give guarantee to C, then B will be considered as an intermediary. The reason being, if you read the rule, in the first set of that transaction, the non-fund transaction is not covered. So which means the fund has to be, in the first place, should be transferred from X to B. Whereas B can either give the funds to C, which means B can give a loan or a borrowing to C, or B can give a guarantee to C on behalf of X as security. So therefore, it is very important to understand this difference. I'll just skip this example and come away to the audit procedures. Now, if I talk about the audit procedures, as I mentioned, it is while completeness, accuracy, valuation, classification, and occurrence are the relevant assertions related to the presentation and disclosure in the financial statement, and in the audit of the disclosure of funding and utilization of fund, the assertion of completeness carries a higher risk. And therefore, the biggest challenge which comes here is to test the completeness. Now, for this, what the guide mentions and the illustrative list of procedures provided by the guide includes, one is the auditor should test the adequacy and operating effectiveness of the internal control laid down by the management for lending or investing and for providing guarantee, security, or the like to any other person or entity. So the entity is required to test the adequacy and operating effectiveness of the internal control. The auditor should also obtain a listing of all loans and investment and guarantees. And they should also look at, and compare the same with the transaction in the general ledger. The auditor should also ensure that the listing includes even those loans that were paid and repaid during the year. And if it's not included, then you need to ask the management to provide you a complete list. Such listing should also be compared with the details of the loans, investment guarantees mentioned in the registered maintained under Section 186 of the Act and disclosures made in the financial statement under Schedule 3 to the Act. And therefore, you will have to make that comparison. Then the purpose of the funding has to be clearly understood. So you will have to make inquiries from the management if the end use is not specified in the agreement for such funding. Test a sample of all loans given, investment made, and guarantees, securities, or the like provided to another person or entity. Also obtain all loan agreements. So wherever there are loan agreement, there are such transactions happening. A company has given a loan to another company. We'll have to look at the underlying loan agreement as well. And you can apply the sampling, which is there in your SA 530 sampling on examining of such loan agreement to understand the purpose of such funding. You can also obtain the minutes of the meeting of the appropriate approving authority who approved the funding, and note if there was any indication that the company was acting as a funding party or as an intermediary. Examine the end-use certificate obtained by the management. So if you remember, I mentioned about the management responsibility, that the management is responsible to obtain the end-use certificate. So such certificate should be examined by the auditor for the amounts funded to determine if any such funding was for onward lending or investing on behalf of the company. And where no written agreement understanding exists for onward lending or investment by intermediary, understanding the timing of the cash flows from the funding party and the lending or investment by the intermediary. The auditor can also share the direct confirmation request. There are confirmation letter formats, which Manoj sir covered in his presentation. 3 formats have been given in the guide, which the auditor can use. Also, the auditor is required to evaluate the compliance with laws and regulation. Now, it's a very important point which one has to note. All the Schedule 3 disclosures, just a second. All the Schedule 3 disclosures have to be given by the management, but when an auditor gives the overall opinion in the audit report, it is mentioned that the financial statement have been prepared in accordance with the applicable financial reporting framework and gives a true and fair view. Therefore, it becomes very important that all the disclosures given in the Schedule 3 are very much part of the auditor's responsibility. Auditor will need to check whether disclosures have been given. So if you go through the Schedule 3 disclosure for this reporting requirement, they are also required to make an affirmation that there is a compliance with law and regulation. That is, which means the transaction are in compliance with the FEMA, Foreign Exchange Management Act, and they are not violative of the Prevention of Money Laundering Act. Therefore, the auditor should also evaluate compliance with the requirements of the Foreign Exchange Management Act 1999, the Companies Act 2013 for such transactions, and the transaction are not violative of the Prevention of Money Laundering Act. The auditor should obtain a separate and a specific appropriate management representation. So as Manoj sir has explained, that it is not only the management representation, but we also have to conduct the procedure. So therefore, after conducting the procedure, the company, the auditor should also obtain a management representation from those charged with governance duly taken on record by the board, which will enable the auditor to comply with the reporting responsibility under Rule 11E. A copy of resolution of the board taken on record, the representation letter, and authorizing specified board members to sign the letter for the issuance to the auditor should be obtained and maintained in audit documentation file. And the representation letter formats are also given in the implementation guide. Now, with this, I'll move to the reporting consideration, and we'll talk about how it will impact your reporting under the auditor's report. So reporting under Rule 11E is based on written representation, management representation letter, and the audit procedures performed thereon. Now, it is very important to note that reporting, though it is worded in a manner which gives an impression that it's a negative assurance, but is it not? But it is not a negative assurance, and the implementation guide clarifies that the reporting is in the nature of an audit opinion, since this reporting is required to be made based on the audit procedures performed. Reporting should be relevant to the circumstances under which such arrangements were made, consider quantitative threshold as well as qualitative materiality threshold. Now, let's talk about the consolidated financial statement. If you look at the original rules, nowhere it talks about whether it is applicable to standalone financial statement or whether it is applicable to consolidated financial statement. And this is equally true for your other reporting requirements in Rule 11, whether it relates to pending litigation or whether it relates to investor education and protection fund. So what has happened is, then for that purpose, you will have to refer to Section 129 of the Companies Act, which talks about that the requirements specified in the financial statements for the standalone financial statement as well as audit thereon has to be is equally applicable. The words used are mutatis mutandis. They are equally applicable to the consolidated financial statements. Therefore, the guide has given you this guidance that when you are reporting on the consolidated financial statement, and if you're not the auditor for all the group, which means you're not the auditor of the component, which could be a subsidiary, JV, associate, then you will have to rely on the report of the other auditor. And how it will be obtained? You will have to apply SS 600 using the work of another auditor. You will have to set the group reporting instructions. You will have to seek a specific reporting. And if there is any timeline difference, so for example, if you're a listed company, you're auditor of a listed company, and you have a deadline of, let's say, May, 30th May, whereas the other component may not be listed, then in that case, you will have to assess whether you have received the report, whether the reporting can be done through group reporting instructions, and accordingly, reporting implications will need to be evaluated. However, the key point here is that you will have to obtain the reporting on Rule 11E and 11F from the auditors of subsidiary, associates, and JV, and request them as part of the group reporting instructions to comment on these reporting requirements. Basis that you will apply SS 600 and you will include the reporting. The guide gives you the reporting format as well for the in your Rule 11E, the wordings for the CFS are given, which can be appropriately used by and customized by the auditors. Now I'm moving on to the unmodified reporting, and on the unmodified reporting. So now this is, if you see, this is nothing but more or less replica of the rule, but some words are very important, which I just want to spend a minute on the unmodified reporting. So this is what you can see on the first bullet is your Rule E1, which is part 1. The management has represented that to the best of its knowledge and belief, other than as disclosed in the notes to account, which means whatever has been disclosed in the notes to account, other than that, no funds have been advanced or loaned or invested by the company or to or in any other person, including foreign entities. Now, these words are very important. So the company has not given any money either to any entity in India or to outside India, which means they even cover the foreign entities. However, if you read it further, with the understanding, whether recorded in writing or otherwise, that the intermediary shall directly or indirectly lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the company. So this talks about a situation, it even covers the foreign entities when you are actually advancing loans or investment. The originating entity is an Indian entity and is giving funds to a foreign entity to be passed on to any ultimate beneficiary. So, and likewise, if you read the second one, which is again an example of an unmodified reporting, Rule 11E2, it talks about if the company has received the fund, which means the company is acting as an intermediary, and there's a situation which is again an unmodified reporting, either there is a transaction which has been disclosed in the financial statement or no transaction, then also the reporting will remain the same. So the management has represented that other than what has been disclosed in the notes to account, no funds have been received, including foreign entities, within the understanding that the company shall directly or indirectly lend or invest in any other persons or entities identified in any manner whatsoever by or on behalf of the funding party. Based on the audit procedure performed that have been considered reasonable and appropriate in the circumstances, nothing has come to my notice. So depending on whether you are signing as an individual or on behalf of the firm, you will mention that nothing has come to your notice that has caused you to believe that the representation contained any material misstatement. So you will have to perform the procedures, you will have to obtain the management representation, and basis that you will have to report. Please keep in mind, even if there is no transaction, this reporting is applicable. You will still have to make a reporting. Also, I want to mention this is applicable to all companies, including, which means your foreign companies, your branch offices. There is no exemption. So this is very much applicable to all the companies registered under the Companies Act. The next one is on the modified reporting. So I just want to highlight and the modification here and will not repeat everything. So it says if there is a modification. So for example, there is the disclosure given by the management is not complete, is inadequate, or they have not given the disclosure. Whereas as an auditor, you have obtained the evidence that there is such transaction. Then in those cases, you will have to mention what is such transaction. So you mentioned that based on the audit procedures that have been considered reasonable and appropriate, except that the company has not been considered as a funding party for loan given to a subsidiary. Now, this could be any transaction, and this is only an example of rupees. So you will have to mention the amount, although the evidence obtained by us indicates so. And then you say nothing has come to our notice. The disclosure is also incomplete in this regard. So what I wanted to focus on is that if you note that it is very important to bring out the exception, what has not been disclosed, what is inadequate or what is incomplete, and then it has to be mentioned. Now, there could be a situation as well wherein you could have a modified opinion only in one leg of the transaction, which means in E1, there could be a non-compliance, there could be no such non-compliance or no such non-disclosure in E2 or vice versa. So in that case, what will be the reporting look like? In the reporting, you will have to mention that we are unable. So for example, if you have not been able to obtain sufficient evidence for the amounts advanced by the entity, whether the company is a funding entity, whether the disclosure made by the company are adequate and complete. So the auditor will have to state that we are unable to state that nothing has come to our notice that has caused us to believe that the representation contained any material misstatement. And then based on the audit procedure performed, nothing has come to our notice that there is any misstatement. So which means your E2 will be clean, whereas E1 will be modified. This is just an example to show you that even if there is no transaction, the company will have to make a disclosure in the financial statement, and you will give a reporting based on such management disclosure that there is no such transaction. Now, there's an example, again, very interesting example. I think Manoj, yeah, he did cover the illustration, and this is how the reporting will look like. So what the guide provides the guidance, it could very much happen that you give funds in year one. So company A has given funds to B in year one, whereas the fact that B will pass it on to C, the understanding will reach in year two. So if the understanding is reached in year two before you sign off, then it will be reported in the same year, which means in year one itself. Whereas if I go to the next slide, if the understanding is reached in year two after the date of audit report for year one, then in that case you will have to report in year one as well as in year two. For year one, you will report only about the fact that the amount has been funded. So the disclosure has to be given by the funding party. And in year two, when the understanding has been reached, the disclosure will be given by the intermediary. So it is very important to understand that when actually the understanding has been reached, and disclosure may come in both the years. So this is just illustrative reporting on the consolidated financial statement. So whenever you are not the auditor, then you will have to mention, or you are the auditors of the components, and then you will have to mention the fact that the respective managements of the company and its subsidiary, associate, and joint venture who are incorporated in India, whose financial statement have been audited under the Act, have represented to us and the other auditors of such subsidiaries. So if you're not the auditors, you will have to mention that, and you will have to accordingly include the reporting in the CFS, the reporting in the auditor's report on consolidated financial statements. Also, it is very important to note that if there is any modification in Rule 11E, you may also have to consider the implication on your main auditor's report, which means your SA 705. Modifications to the opinion in the independent auditor's report. The auditor should also consider the impact of such modification on the other reporting requirements, such as opinion on internal financial control with reference to the financial statement, related party disclosures, since the transaction envisaged under Rule 11E1 and 2 are more likely with the related parties, reporting under Section 143.3.1a, 143.3a, 143.3f, and reporting under Clause 13. So you have to keep in mind, in nutshell, the implication on the other auditors reporting clauses in CARO or in the main auditor's report. So as I mentioned, there are illustrative format of confirmation letters and management representations. So this slide, I've just replicated the format, so you can refer to the formats, ask the company to send these confirmation, to the parties. So there are separate confirmation format to be given by the party providing the funds and including intermediary acting in such capacity. The second format is on the party who is to the intermediary. So the response to this confirmation request will be provided by the funding party or intermediary in the capacity as funding party. So there are separate formats for the funding party, for the intermediary, and for the ultimate beneficiary. So there is also a format for the party who is the end recipient of the funds or guarantee, security, or the like. So the formats are very much there in the guide, which you can use, and the client or the company should request that such confirmation should be given directly to the auditors. So the formats have been given. With this, I'll just take a pause, and now I'll go to the dividend norms. So the overview has already been given by Manoj sir on section 143(3)(f). So I'll start with the same background that this is something which we were already doing as an auditor. So if I talk about the dividend declaration, so there is no change in the objective and scope of an audit of financial statement due to inclusion of Rule 11F, because pursuant to the requirements of SA 250, consideration of laws and regulations in an audit of financial statement, we were always required to make an assessment regarding compliance with provision of various laws and regulations. Now, by virtue of this new reporting requirement, auditors are now specifically required to comment on compliance with provisions of Section 123 of the Companies Act 2013 with respect to the dividend declared or paid during the year. Now, interim dividend can be declared out of surplus in the profit and loss account. So these are not new principle, but just for the benefit of, there's a summary given in the guide as well as in the presentation. So interim dividend can be declared out of the surplus in the profit and loss account or profit generated in the financial year till the quarter preceding the date of declaration of the interim dividend. So for example, if you are declaring the dividend, let's say in the fourth quarter, which means in the March quarter, then you can use the profit for your in the quarters generated till December 2021, and profits of the financial year for which such interim dividend is sought to be declared. So you can very well, a company declares interim dividend, let's say in the month of May for the year ending March 2022, and the profits for the year March 2022 can be used for declaring such interim dividend. Proposed final dividend can be declared out of profits for that year arrived at after providing for depreciation, or profits for any previous financial year arrived at after providing for depreciation and remaining undistributed, or both of the above. Now, in case of inadequacy, absence of profits in any financial year, and a company still want to declare a dividend, there are dividend rules which a company needs to comply with. Amount of dividend, including interim dividend, has to be deposited in a scheduled bank in a separate account within 5 days from declaration. And the company is not permitted to declare any dividend on equity share in the event of continuing default with section 73 and 74. So before the reporting requirement, I'll just like to mention, and I think Manoj sir mentioned about the accounting and the disclosures for the dividend. So it is very clear. So AS4 and and NDS 10 talks about the dividend declared. So if the dividend is declared after the balance sheet date, the enterprise should not recognize that as a liability. Therefore, the company will give a disclosure. And as an auditor, our responsibility will be to see whether the company has declared dividend subsequent to the balance sheet date, and if yes, whether the disclosure has been given. And therefore, the reporting, if you look at the wordings of the reporting, whether the dividend declared or paid during the year. Therefore, it is very important to see whether the company has declared the dividend or has paid the dividend during the year. Also, it is very important to note that we are talking about a financial year. So, which means if the dividend is declared for March 2022, then we'll have to see the interim dividend, whether it relates to March 2022. So if the interim dividend is for the next year and declares after the balance sheet date, then we may not be required to report here. So it is very important to focus on the words, which is for the financial year and the dividend declared or paid during the year. Now, what is relevant here is that the amount of dividend should be deposited in a scheduled bank in a separate account within 5 days from the date of declaration of such dividend. The amount deposited in such bank account can be utilized only for the payment of dividend or for transfer to unpaid dividend account, investor education and protection fund, and for no other purpose. Mere transfer of funds to a separate bank account will not amount to payment of dividend by the company. Also, the guide provides what is meant by paid. The word paid implies the act of posting of dividend warrants for checks, including through electronic clearance services facility. The payment of dividend should be made in accordance with the requirement prescribed under Section 123 of the Act. Any deviation will lead to non-compliance and will have to be reported by the auditor. Also, it is important to note the auditor shall verify the compliance till the date of the auditor's report. Now, moving on to the auditing procedures in general. Which specific procedures have to be carried by the auditor? So the auditor will have to evaluate the system of internal controls relating to the payment of dividend to determine the nature, timing, and extent of the audit procedures. So the auditor will have to obtain the, in case of interim dividend, the auditor will have to obtain the interim financial statements for the relevant period to determine the adequacy of profit to declare such interim dividend. And in considering such interim financial statement, the auditor shall consider any modifications, so which means any modifications in the auditor's report for the previous year in respect of adequacy and operating effectiveness of internal financial control. So which means the auditor will also have to consider the qualifications made in ICFR report, and the auditor will have to see whether those have been duly mitigated by the management in preparation of the interim financial statements. This would provide the necessary evidence to the auditor that the company's internal controls operated effectively to enable the management to prepare such interim financial statements. In case the company has incurred loss during the current financial year up to the end of the quarter immediately preceding the date of declaration of interim dividend, the auditor also needs to check and verify that such interim dividend is not declared at a rate higher than the average dividends declared by the company during the immediately preceding 3 financial year. In case of any dividend declared or paid during the year, which includes your interim dividend as well as proposed dividend, the auditor also needs to evaluate if the management has duly considered the effect of any audit modifications when determining adequacy of profits for declaring or proposing dividend. In case the audit modification is not quantified, the auditor also needs to evaluate management's quantification of the effect of such modification on a best estimate basis and determine whether the company has adequate profits after adjusting such best estimate when declaring the dividend. This point is very important, and one should keep in mind it has been introduced in the guide that one has to give the impact of the modification. So if there's a qualification, let's say in year ending March 2021, and the company wants to declare a dividend for March 22. So when you are opining on the fact that whether the dividend declared is in accordance with Section 123, you will have to see any modification, whether in March 21 or even if it's March 22, what is the quantification, and look at the management's estimate of the quantification and see whether the company has adequate profit after giving effect to such impact of such modification. So this is something very important. Another point is on the dividend rules. So in case of declaration of dividend out of reserves, verify whether the same is in accordance with Rule 3 of the company's declaration and payment of dividend rules, that is declaration of dividend out of reserves. Verify that the dividend has been declared by the board of the company and not by any other committee or subcommittee of the board, since the power of dividend declaration cannot be delegated. So you will have to keep in mind the provisions of the Companies Act. Obtain certified copy of the resolution declaring such dividend and verify that the board general meeting where such dividend has been declared was duly convened. The auditor also needs to verify the details of transfer of the dividend declared to a separate bank account as required by Section 123 of the Act. The auditor also needs to check the compliance with the applicable laws and regulations. So this is the auditor will have to check the compliance. The auditor will also have to see whether the dividend to the extent paid is only to the registered shareholders and in accordance with subsection 5 of section 123, and where the payment of dividend is through the registrar and transfer agent, the auditor should consider obtaining independent confirmations from the registrar and transfer agent with regard to checking the compliance. And the auditor may also examine the investor complaint with regard to dividend to see if any of them indicate any non-compliance. The auditor's work paper should document the testing performed on the calculation of the profits, which is in accordance with section 123. And when performing procedures for testing compliance with the provision of 123, the principles of materiality will not apply. That is there in the next slide as well. So and the representation has to be obtained. So when I say the principle of materiality will not apply, because this is a specific requirement introduced, and now a specific comment has to be given by the auditor. And since it's a specific reporting under Rule 11 for checking compliance with the provision of the Act, therefore the guide mentions in that it will not be having any threshold for materiality. So which means if there is a non-compliance by the company, it has to be reported by the auditor. So so this is something very important the auditor will have to keep in mind. For the interim dividend, I think I've already covered on the procedure. The auditor have to look at the interim financial statement to determine the adequacy of profit. The auditor will also have to see the rate interim dividend declared. It should not be higher than the average dividend declared by the company during the immediately preceding 3 financial year. Materiality, as I mentioned, would not be applicable since the reporting is toward a specific compliance with the provisions of section 123 of the Act, and which does not prescribe any threshold for materiality. Another very important aspect on the CFS, as I explained in Rule 11E, it is equally applicable to Rule 11F. So the reporting is also applicable as given in the guide to the consolidated financial statement. It will be based on the statutory audit reports of statutory auditors of subsidiary, associates, and joint ventures that are Indian companies under the 2013 Act, where we are not the auditors of all the component. Where component auditor report is pending, parent auditor to take inputs from the auditor of subsidiary, associates, and joint ventures and request them as part of the group reporting instructions to comment on these reporting requirements. The auditor will have to comply with the SS 600 principles. Also, I would like to add that in case of listed companies, the auditor is required to report on the audited financial information being submitted to the stock exchange within the timeline specified in SEBI. Which will contain where such audited financial statement or the information will contain details of the proposed final dividend. In these cases, the auditor should request the management to provide them with a computation of profits available for distribution as dividend, along with the maximum percentage of dividend that may be declared considering such profits, and verify such information so as to enable them to report. So within the timeline. So in case of listed company, the auditor should also obtain such information, which is submitted with the stock exchange. Also, it is very much possible, for example, in case of NBFCs, additional provisions may be applicable. There could be additional circulars, RBI norms that may also have to be verified by the auditor. However, it may be noted that there is no reporting requirement for compliance with the set requirements while you are reporting under Rule 11F. So which means we will not comment on compliance with such NBFC circulars or RBI norms, even if it's applicable for payment of dividend. So that has also been clarified in the guide. And now I'll cover the illustrative, reporting and the scenario just to give you an overview of the various scenarios. So the next 2 or 3 slides talk about when the reporting will be triggered. So there's an illustrative list of various scenarios explaining the applicability of the reporting requirement. So if there is an interim dividend for year 1, which is declared and paid in year 1, so that has to be reported in year 1 because that has been declared and paid in year 1. If there's an interim dividend for year 1 declared in year 1, paid in year 2 before the date of audit report for year 1. So it is very important to note that here it has been paid in year 2 before the date of audit report. Then again, it will be reported in year 1 only because that has been paid in year 2 before the date of the audit report for year 1. So no reporting will happen in year 2. And if I move to the next scenario, interim dividend for year 1 declared and paid in year 2 before the date of audit report for year 1, then again to be reported in year 1 and not required since already reported in year 1. But if I take this scenario where the interim dividend for year 1 declared in year 1, 2, but paid after the date of audit report. So what has been changed here is once you pay after the date of audit report, so in year 1, the declaration will come that the dividend has not been paid, but has been proposed or declared. However, in year 2, it has to be reported for the payment and also reporting for the declaration stating that the dividend was declared in year 1, but paid in year 2. So another, the next two examples are flowing from this, so probably we can skip this. Now coming to another scenario where you have 3 years involved. So which means in interim dividend for year 2 declared and paid in year 3 before the date of audit report for year 2. So in this case, since the interim dividend for year 2 was declared and paid in year 3 before the date of audit report, it will be reported in year 2. However, if interim dividend for year 2 declared in year 2 and 3, which means the declaration will come in your year 2, but paid after the date of audit report for year 2. So therefore, the reporting will come in year 3 with the fact that the declaration happened in year 2. So similarly, there's another example of final dividend. So final dividend for year 2 declared and paid in year 3. In this case, nothing will be reported in year 1, but in year 2 to be reported in year 2 for the declaration stating that the final dividend is proposed and will be paid after approval by the members in the general meeting. This happens in many cases, and it's very common that the declaration may happen and it will be paid only after approval by the members in the AGM. And if the payment happens after the auditor's report date, then it has to be reported in year 3 for the payment stating that this reporting is in relation to the final dividend for the previous years approved by the members in the AGM. So these principles will apply equally for reporting on declaration and payment of dividend on preference shares as well. Now, these are only illustrative languages for the standalone financial statement. I have also included for CFS. So if everything is clean, the company is in compliance, then the reporting will come as part of your Rule 11 and a report on other legal and regulatory requirements that the interim dividend declared and paid by the company during the year is in accordance with Section 123 of the Companies Act 2013. Where final dividend has been proposed, then in that case, you will draw a reference to the note where the company would have given a declaration or would have given a disclosure for the final dividend. The board of directors of the company has proposed final dividend for the year, which is subject to the approval of the members at the ensuing general meeting. The dividend declared is in accordance with Section 123 of the Act to the extent it applies to declaration of dividend. But if I move to the next slide and take an example of a modified reporting, now in case of non-compliance related, so let's say there is a non-compliance regarding the transfer of amount to a separate bank account. However, the company is in compliance with the other provision of Section 123. So in this case, in respect of dividend declared and paid during the year by the company, except for not transferring amount of dividend to a separate bank account within the timeline specified in Section 123(4), declaration and payment of dividend is in accordance with Section 123. So here you will have to bring out clearly what is the non-compliance. So the intention of inclusion of this example is to just to explain, we'll have to clearly bring out what is the non-compliance, whether it's in transfer of the amounts, whether the profits are inadequate, whether there is any non-compliance, whether the shareholders' approval have not been obtained, any violation with the principles provision of Section 123 and the dividend rules needs to be checked and reported by the auditor after introduction of Rule 11F. This is on the inadequacy of profit. So I mentioned about the inadequacy of profit, and there's a very good example. So if, for example, if there is a modification and the management has not considered the effect of the audit qualification when in computation of the profits for declaring the dividend, then the auditor will have to bring out this fact very clearly. So the wording will be like, in regard to the dividend declared and paid during the year, the management has not considered the effect of audit qualification in determining the adequacy of profits for declaring such dividend. And based on the estimates of the amount quantified, the company would not have had sufficient profit. Now, this will be the reporting where the qualification can be quantified, because herein you can quantify what is the amount of the profit that would have been or not available if the company has given effect to the qualification. However, if you cannot quantify, if the management cannot quantify, then you will have to give a wording like which is like a scope limitation, wherein you will have to clearly mention we have not been able to opine on the reasonableness of the estimates made by the management. So there's a very significant provision included in the guide, and therefore one needs to be very, very careful whenever there's a qualification in the audit report. The auditor also needs to assess the impact of the modified reporting under Rule 11F on the reporting on the financial statement, including opinion on the internal financial control with reference to the financial statement where applicable, and report in accordance with SA 705. This is on CFS. Yeah, so the CFS wording are not there in the guide, but yeah, it will be akin to what we have seen in Rule 11E. So you will have to bring out the reference that if the dividend has been declared during the year by the holding company, and if it's subsidiary, JV, associate, so you will have to obtain the specific reporting from the component auditor, and you will have to mention that about the reports shared by the other auditors. And if no dividend has been declared, then you will have to specifically state no dividend has been declared or paid during the year by the holding company, subsidiary, associate, and JV company. So with this, I'll just give it back to Anilji. So if we have any questions, then we can take the questions now. Do we have any questions? Yeah.
Can you hear me, ma'am?
Yeah, I can hear you.
Yeah, thank you so much, ma'am, for such a wonderful deliberation. We have gained a lot through your deliberation, ma'am. And in absentia of our honorable past presence, sir, Manoj Patnis ji also, both the deliberations were full of knowledge, and it was very, very informative. Ma'am, I have received certain questions. If you permit, may I ask questions?
Yeah, just allow me a minute. I didn't realize I'm running out of battery. Give me a minute only. Just a
Yes,
minute.
ma'am. Yes, ma'am.
Yeah.
Yes, ma'am.
Yeah.
Yes, ma'am.
Yeah, I'm back. Sorry. Apologies. Sorry, I can't hear you.
Now
Yeah.
I am audible, ma'am.
Yeah, you're audible.
Your camera is off.
Sorry.
Camera is covered.
Yeah, I think it's fine now. Yeah.
No, it's fine, ma'am.
Yeah.
Ma'am, first question is, I hope you have already received regarding the audit procedures.
Yeah. Right.
Please explain what could be the probable audit procedure to verify the correctness in the representation given under Rule 11E.
Yeah. Yeah, so I did covered a very detailed slide on the audit procedures that the
Yes.
auditor will have to start with the list of loans and look at the borrowings, all the transaction, cross-check it with section 186. The auditor will also have to ask for the board meeting minutes. The auditor will also have to obtain a management representation. So the procedures are there. Yeah.
Yes, ma'am. Ma'am, interim dividend declared, one technical question. Interim dividend declared on 23rd March 2022 and paid on 24th March 2022 directly to the shareholder without depositing in the bank as required under section 123 post. So clarification is required in this compliance, ma'am.
Okay. So if it has been paid directly without depositing in the bank account, then it will be a non-compliance. We'll have to look at the respective rule, and if it's a non-compliance, then it has to be reported. So, which means even if you can say that it may not require a modification in the main auditor's report, but it will require a reporting in Rule 11. Yeah.
Another question is the company has taken loans from related parties in the past several years. This has no repayment schedule. As the company progresses, generates surplus, the loans are not repaid. However, the surplus funds are further lent and invested in other parties. Whether these transactions would be covered for reporting, and if yes, how to report such transactions?
Okay. So I'll take it in two parts. So loan has been given to repayment related parties and no repayment schedule. So one, we will have to report it in CARO, wherein there is a specific reporting in the CARO if there is no repayment schedule specified to any of the parties, irrespective whether related or non-related, that has to be reported in CARO. Secondly, we will have to see that even if there is surplus fund and that has been invested in other parties, so we will have to see that what is the transaction which is happening. So if the amounts has been just passed on to the other parties through this related party, so let's say Mr. X is a related party or any company is a related party, then in that case it may have to be reported. So you will have to look at the transaction and the movement of the transactions, the timing of the movement of the transactions.
Time and movement of the transactions.
Yeah.
Ma'am, one question is related to the modified opinion. Member is asking, modified opinion will lead to the internal control deficiencies. Will this always be considered as a material weakness? Is there a criteria to be considered to evaluate its severity?
Yeah. So now if there is a qualification, it may indicate a material weakness, and that has been explained in the guidance note on internal financial controls. However, you will have to look at the systems as well. So if there is a modification, it's a one-off transaction, whether the management has implemented controls at the end of the year. So I think we should make reference to the guidance note on the internal financial controls for this.
Yes. Will there be any specific disclosure required for loans and advances obtained in the years prior to the implementation of Rule 11E, where the utilization of funds have occurred? Utilization of funds have occurred in the current financial year, that is 2021-22.
It's a very good question, very interesting question. Because the guidance note in Schedule 3 talks about the disclosures to be given and including the comparatives. So which means I have an outstanding balance which was not utilized in the previous year but utilized in the current year. It appears that it has to be reported because the utilization happens in the current year. So which means the understanding has been reached in year 2, which is current year. So for the outstanding balance as well, the company will have to make a disclosure and accordingly the auditor will also have to report. Yeah.
Sure. Average rate for the last 3 years is not applicable in case the company has declared in the last 3 years. In this case, what will be the maximum rate?
So if the dividend has not been declared, it is probably a legal interpretation. So I would like to park this question for the time being.
Pardon, ma'am?
I'm saying it's more of the interplay of the rules of the Companies Act. So if there is no dividend, probably one has to see how it will interpret. So it's more of the Companies Act question, and I can check and get back. Yeah.
Yes. One question, last question, ma'am. if the company gives loans or guarantees as per section 186 or in the violation of section 186 limits, that is board or EGM resolution, without proper agreement, will it not attract adverse commitment of auditor as a failure if internal control system regarding management of funds?
Yeah, so if I understand the question correctly, there is no written agreement, right? This is a question. However, if it is basis the board discussion, so therefore the guide talks about all such transaction has to be first of all documented, approved by the board. Even if it's an oral transaction, that has to be documented by the board, but it's very difficult to say that it will be an always a failure. It's very difficult to conclude that. So it depends on the facts and circumstances. Yes, it could be an indicator of a material weakness because the transactions are happening orally. And first of all, it raises a question on the governance only, that why the transactions are happening orally, why there is no written agreement for the underlying transactions. So yes, this is an indicator.
Yes, ma'am. Thank you so much, ma'am. Now come to the end. It was really wonderful session once again. Your deliberation regarding 11E and 11F, as well as the honorable past presence, sir, Manoj Fadnis ji. Definitely, we have gained, all our members have gained a lot through both the deliberations on 11E and 11F, and which is a very important topic for today's VCM, ma'am. On behalf of WBSP of ICI, I extend my heartiest thanks towards you as well as Honorable Past President Sir CA Manoj Fadnis ji in his absentia for sparing your valuable time. And again, on a very shorter notice, acceding to our request on a very, very shorter notice, ma'am. Thank you so much, ma'am.
Thank you.
So much.
Thank you, sir.
Thank you.
Thank you. And thank you everyone for attending the session. Thank you.
Thank you. Thank you.
Thank you. Bye.